Good evening, everyone. Welcome back to the Online Investor's Guide to Thriving for August 27th, 2020. Hope everyone's enjoying the last few days of summer. Certainly, it's been a beautiful and warm one here in Toronto, but even with the humidex, the weather has been nowhere near as hot as the NASDAQ. While bank stocks are still down 15% and the average stock down about 10, tech has been bid up so much that it's actually lifted the broad indices higher on the year. In honor of this fact, we can all party like it's 1999. Tonight, Larry will attempt to make some sense of this with lots of charts, but you can also get some quick takes from Larry with his weekly market summaries on the Larry Berman official YouTube channel. The great part about these is that they're just 2 to 3 minutes long, so you'll get an idea of what's been moving markets without having to invest too much time. Don't forget to hit the subscribe button and the little bell icon next to it so you can get a notification when Larry posts a new video. I'm personally loving these on my Android device. More big news. Next two Berman calls are going to be Friday at 4:30 p.m. Eastern Time, but starting September 14th, Berman's call returns to its regular time slot of 11 a.m. Eastern Time on Mondays. For those of you who are used to seeing Justin Trudeau announcing more money printing at that hour, it sounds like perhaps that's going to subside. Now it's over to Tiff Macklem. Now, if you enjoy our webinar format, good news on that front. Investor's Guide to Thriving returns to a weekly format starting October 1st through December 3rd, each week at Thursday, 7 p.m. Eastern. Usually this is when we do our cross-Canada roadshow, and we do find that we do these in the spring and the fall because that tends to be when markets are most active and most investors are looking for more frequent updates at that point in time. So hopefully this will align nicely. We've got lots of things happening this fall, US election, there's a thing called COVID that apparently is still happening. So we'll have lots of coverage of that this fall with the Investor's Guide to Thriving. If all that sounds like too much information, we can do the hard work for you so you can have more time to enjoy your day and still sleep at night. We've partnered with BMO to offer ETFs and funds of ETFs managed by Larry and available to you through your online brokerage or investment advisor. If you don't have an advisor but do have a portfolio of $1 million and up, our ETF Capital Management Private Wealth team would be pleased to offer you a wealth management proposal. As you would imagine, this way of working together allows us to make the fullest use of our wealth management and investment toolkit. You can learn more or request a proposal online at etfcm.com. If you just want to watch the replay of tonight's webinar, all you need to do is complete the event survey. Tomorrow morning, you'll receive an email containing the survey. Tell us how we did, and you'll get a link to access all the above and submit questions for the next webinar. Investor's Guide to Thriving comes to you at no cost in favor of two causes that Larry and I believe in passionately: Sick Kids and the Baycrest Foundations. We hope you can join Larry and I in supporting childhood leukemia research at Sick Kids. We also appreciate your support for the groundbreaking work being done at the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you so much. And if you'd like to make a donation after the show, please use the links in the survey that you'll receive after the event. That allows Larry and I to track and match your donations. Thanks also to our sponsors, National Bank Direct Brokerage, whose support has brought us Larry's first set of Investor 101 videos on YouTube. And of course, BMO ETFs, who have been our top tier partner in investment education since they first started in 2009. Their efforts to inform investors are top tier, and so are their friendly and knowledgeable ETF specialists. So I'm happy to introduce, all the way from Vancouver, BC, where apparently the weather has been nice this summer as well, Renee Dinter from BMO ETFs.
Thank you, Jared. It's great to be back and talk to a little bit about the BMO exchange traded funds and the various options that we have for the investing public. I'll start with the BMO ETF's pillars. These four pillars are generally representative of the overall ETF market. There are four distinct types of ETFs available in the market, and it's a great roadmap for trying to navigate the almost 1,000 different ETFs in the Canadian marketplace. Starting from the left to the right, smart beta ETFs or factor-based ETFs are very popular. They're growing in popularity. These are often ETFs that make a specific tilt away from the cap-weighted index, like low volatility, quality. Most popular are the dividend factors, where individuals are seeking income from their portfolios. Innovative solutions is a pillar that, by and large will represent the other category, active innovative solutions. Today, I'm going to focus in on our suite of covered call ETFs that enhance income beyond just dividend generation, but will also give you that extra little bit of income in your portfolios. The other two are probably the more popular and the ones that are really synonymous with the ETF universe. Obviously, there's fixed income ETFs. The largest fixed income ETF in Canada is the BMO Aggregate Bond Index ETF, ticker symbol ZAG. It represents the entire bond universe in Canada. Beside that, the effective broad market ETFs, these are your traditional cap-weighted indexes like the S&P 500 or the TSX Composite. Very inexpensive ways to get market beta. As I narrow our focus into our innovative solutions, I'm going to talk a little bit about our covered call ETFs and start with the options capabilities at BMO ETFs. BMO ETFs is currently the largest options manager in Canada, trading on average about 500,000 different option contracts per month with 15 different counterparties. There's a lot of active management going on in our suite of covered call ETFs. And so we are managing a lot of options positions. These strategies range from Canada, US, and international markets, and currently make up about $6.5 billion out of the $67 billion in assets in BMO ETFs. When we look at how much of the market of covered call ETFs BMO represents, we are 75% of the assets in covered call strategies. So by far the market leader in this space. Before I get started, I thought I'd just do a quick little recap on what a covered call strategy is. In this example, you can see that a risk return profile for a covered call, at the money covered call position. So for example, if you started with a $60 stock and you wrote an at the money call at $60, 1 month call, and to generate $1.50 or $1.50 in income, you can see that you've enhanced your income by selling away potential growth beyond $60 of the stock price. So at the money, $60. If you sell that away, that potential growth, you receive that $1.50 income and you keep that no matter what. That's income in your pocket. It also helps offset some of the risks of holding that stock, where you can now still have a positive return even if the stock price falls, because that fall in stock price up until the $58.50 mark is covered by that income you've received. So this is a nice illustration of an at-the-money call option being written on a $60 stock to generate $1.50 in additional income. Now, why would I do that? Well, why use covered calls at all? Investors use covered calls to generally increase the amount of income that they're receiving in their portfolio. They do that in order to lower the overall volatility of their position through that extra income. As I talked about earlier, you have some downside cushion on your position through the income you've generated. Also, the income you're generating is tax efficient. And when wrapping this process, which can be a very involved process in writing calls on individual securities, when we wrap it all up together and we do that for you, we can do it at a very low cost to you, the end investor. And so we can take on a lot of that work and go and manage those positions on your behalf. But why covered calls? Then why are we doing this? The general idea of covered call strategies is that it reduces the range of possible outcomes and creates stability in a portfolio. The reason for that is that extra income will help offset any declines in stock price, so it helps to reduce the downside volatility of your portfolio. And although you may be selling away outside gains, and we'll talk a little bit about that in a second, you may be selling away some of those outside gains in the portfolio. You're still benefiting from that extra income being generated by writing calls. So you're narrowing the range of outcomes and having a nice steady experience in your investments. Now, when we talk about covered calls, another important factor to consider is the underlying portfolio itself. What stocks are we writing calls on? In the case of BMO ETFs, by and large, most of our covered call portfolios focus on dividend-paying stocks. We focus on these dividend-paying stocks, and we do so through a methodology of screening for companies that have sustainable dividends, so they've been consistently paying out their dividend yield. We look for companies that are growing their dividends. So we're looking for companies that continue to grow their dividends as well. Those are two major factors when we design our underlying portfolios. And so we're looking for good quality dividend paying companies. And then when we decide on how much of each position to own, we use a screening by yield. So we have a yield weighted portfolio to deliver a high amount of income. The key is to look for as much income we can from stable or growing dividends of big companies, either in Canada, the US, or international. And this kind of gives you a snapshot of enhancing those dividends. So again, as I mentioned, we start with a portfolio, a dividend yielding portfolio for a strong base to generate that reliable dividend income. And then using an active approach to call writing and options, we're able to generate a return profile that reduces the overall volatility. We can use shorter dated options that are out of the money. So in contrast to the example earlier, which was an at the money call option, we can write out of the money to allow some room for our stocks to grow and participate in the stock price appreciation of those stocks, and only sell away the upside beyond a certain point. Typically where we would expect to have the stock not really get to. And so we're selling away upside that we wouldn't see in the stock on a regular basis. We can also manage the percentage we write of each individual stock, so that instead of us selling away upside on the entire position, we're only selling away on part of it, so that we can really allow those stocks to appreciate and get some price appreciation or NAV growth of our ETFs. So how do covered calls, and in order to manage expectation, how do covered call strategies behave, and what type of markets do they do best? Well, in a down market, as I mentioned earlier, covered call strategies are able to generate that extra income to offset some of the declines and allowing you to outperform in a down market. Also, we see that in periods of increased volatility, option premiums actually increase. So the income received on our portfolio increases in periods of market volatility. Now, as I have mentioned in the past, there is a trade-off for that extra income, where in a rapidly rising market, we may give away some of the growth, not all, because we are writing out of the money on less than 100% of the portfolio. So we will get some upside, but we may give away some of the upside in a very rapidly rising market environment. Where covered call strategies do best? In a sideways or range-bound market. In this type of environment, where dividend yields are stable, volatility is generally pretty consistent, we're able to generate good income by selling calls not get called away on the underlying stocks, and produce good income to help us outperform the overall market. So the total return experience is very positive for the investor. Here's a quick snapshot of our lineup. This is available on our ETF roadmap, which can be downloaded from our website, bmoetfs.ca. Here we have an entire view of all the different covered call strategies from Canada, US, Europe, or globally. And on this document, there are actually hyperlinks, which will take you to the underlying fact sheets or fund pages where you can see the underlying holdings for all of them. So again, bmoetfs.ca, and there's a tab at the top called ETF Roadmap, which you can download and take a look at the various options that are available. As support for our investors, we also produce a one-pager that highlights the top 5 income-generating ETFs in our lineup. And as you can see here, the top 3 are covered call ETFs, one focused in Europe, the other a global strategy, and our ZPay, which is a combination of covered call writing and put writing to generate income on stocks. So those are 3 examples, and look at those payouts. That is dividend income plus option premium through covered call writing. Lastly, we do have a weekly webinar series. You can request this. You can subscribe or to this webcast by simply subscribing to the information at the end of this presentation from Prosper Experiential, where you will then receive invites for our weekly webinar talking about exchange traded funds every Friday from 1 to 1:30 p.m. Eastern time. Well, that is a quick rundown of our BMO ETFs and BMO covered call ETFs. With that, I will turn it over to our featured speaker, Larry Berman.
Thanks very much, Renee. Good to virtually see everybody, although I can't see you, and I think you guys can see me now. So, you know, big challenge in the yield space these days. There's not a week that goes by that I don't get a question like the one Mark just sent in on the website here, asking for a replacement for fixed income ETFs. And I asked BMO to create the ZPay ETF a couple years back, where we wanted to combine the best of covered calls and put right strategies into one overall solution, that when the markets go a little bit higher, you're still generating the yield, but you sell a little bit. And when the markets sell off, you end up with the put writing strategy, you end up getting a bit longer. So you're buying low, selling high, always generating a very nice yield. And, you know, for that reason, it's the biggest exposure right now in all my sleep at night portfolios that we manage for BMO. So tonight I want to talk a little bit about the world, update a bit on my market outlook here, and then answer your questions at the end. So, you know, we're in a bubble. So what do we do now? A little bit about the Fed and the moral hazard behind all the central bank support for the world and what's gone on with the markets here. I want to talk a little bit about stock splits and chasing markets here. You know what I say, you give someone a $5 bill and you get 5 singles for it, you're not any better off, you're equal. A stock split is exactly that. You've got this new generation of investors spurred on by the Robinhood crowd and others that somehow think it's bullish, that you know, adds value when you split a stock, which is not the case at all. But I want to talk a little bit about indexing and rebalancing, because that's a little bit interesting right now, and will be the subject of my Berman's call tomorrow. And of course, a little bit about the upcoming US election and what we can expect there. And then we'll get to your questions. So this is a graphic of the total return since Donald Trump became president, of the average stock. So the value line geometric average represents the day-to-day price change of the average stock. And as we can see from end to end, it's had absolutely no growth at all. When we look at the FANG Plus group, Facebook, Amazon, Apple, Netflix, Google, Microsoft, can add a few more names to that make up sort of the top 10 tech names, but basically they've been doing all the lifting in the market. And we go from time to time, we go through pretty significant corrections. But the technology space is probably going to continue to outperform for a number of years now. It's incredibly overvalued from a risk return perspective today. Nevertheless, the Robinhood gang is buying call options and speculating, and there's a tremendous amount of, I would say, not fundamental investing, not really fundamental investing. And me, I'm a fundamentalist and I'm a technical guy, and I do a bit of both. So I wanted to talk a little bit about my philosophy on the difference between trading and investing. So it's the idea of relative risk and absolute risk. And when you're a portfolio manager, as I am, you get benchmarked to an index. You're trying to beat a strategy. In the global dividend fund, it's the global dividend index that we're trying to beat. In the global growth fund, it's the global stock market. In the global balance fund, it's a 60-40 balanced portfolio that we're trying to beat. We're trying to beat it in two ways. The sleep at night way is by having less volatility, and in the traditional way of delivering excess performance. When it comes to trading, you want to be very short-term in nature, generally speaking, and the current market is very much about trading, versus investing, where you want to be long-term, more strategic. And I've said for a while, people ask about the energy sector. I said the difference here is we're in a sector that has a long-term path of decline. And whether you want to hear that or not is a different matter. But I believe the world is serious about climate change, and over the next 10, 20, 30, 40, 50 years, we're going to move off. So when I get into talking a little bit about the policy differences between the Democrats winning and the Republicans winning in the States, that's a very big issue, because the Democrats have this green vision and the Republicans don't think generally climate change is a thing. So you have a very, very different approach to the energy sector and to green energy. And depending on how the election plays out, that's night and day difference. So when people say, should I buy energy stocks here, or this beaten up one or that beaten up one or whatever, to me, that's investing. So is it investable? Is it Warren Buffett investable? And when I think about Warren Buffett investable, I look at weekly charts. And I've pulled up the NASDAQ here because that's the Qs. That's what everybody kind of wants to know about in technology and the like. This spread above the 200-day average and the 200-week average, the last time we saw this type of deviation from the mean was back in the tech bubble, late 1999s, 2000. And really, when you get into a manic market like that, there's absolutely no telling when it's going to stop. But when it does, typically the correction is quite dramatic. The main difference between now and 20 years ago in the tech bubble was these companies have real earnings, real sustainability, and it's not, in many cases, not a young industry. In fact, it's a mature industry when you look at companies like Microsoft, for example. But Amazon 20 years ago fell 96% when the tech bubble came unglued. For Amazon to fall 96% today would be quite a feat. Could it get cut in half on antitrust issues? All those things are very possible. So the risks as we go higher are increasing. But on a risk return basis, when we talk about investing in a theme that long term we think is going to continue to work, you want to buy dips. And the question is, where do you buy them? So the pink line here is our 200-day, or on a weekly chart, it's our 40-week, and our long-term 200-week moving average. And these are generally pretty good guidelines that when, you know, in an uptrend, when you fall below the mean, that's usually a much better risk reward. You don't know where it's going to stop. That's the hard part about buying into pullbacks. Now you can wait for the reversals and things like that. And there's a lot of things you can do from a technical perspective to try to improve your timing. But getting the direction right, so being in things that are relatively outperforming are generally the right idea, up until a point where it gets terribly expensive and the risks no longer you know, are worth it. Now, to me, that happened 20% ago, 25% ago on the Qs. And yet it keeps going higher. So where do you buy this thing? Where do you get involved? Well, if you look at an indicator like the RSI and you kind of say, well, when this thing gets overbought above that 70 level, you know, what is the average return when you look out a year? And so in some cases, it's still positive. So look at 2017 into 2018, right? It got overbought in second quarter, first quarter, second quarter of 2017. It corrected in the third quarter, but it went sideways correction. It didn't actually go down. Where finally we got a little bit of volatility in the volatility blow up in early 2018, and then more importantly as the Fed started tightening policy in late 2018. But really, you know, once the Fed started easing again, you know, risk on. So it's very possible, in big picture speaking, that outside of minor corrections, say back towards the 40-week average or something less than that, the technology is going to continue to outperform for a long time. But to me, it's hard to invest at the moment. So when it comes down to more of an investing time frame, here's one of the things that I like to do to get in. I look at relative. So when you compare what something's doing performance-wise, you want it relative to your target. And for me, in a growth fund, the target is the world index. And I use the VT, the Vanguard Total World Index. Or maybe on a broad basis, you could use the S&P 500 as a global benchmark. It makes up 40% of the world index. So that's doable. And on a relative basis, I use a statistical technique called regression. There's many of the independent softwares out there that you can buy or have access to on trading systems where you can run a linear regression. So it's a statistical technique that shows you the mean plus or minus 2 standard deviations. And that's kind of what we see here. So the top chart is our price chart. And I prepared this a couple days ago. And so we're a little higher than this right now on the Qs, but not much, maybe 1% higher. And so you can see now on a relative basis, compared to the world index, we're getting to the overbought, the top end of the band, as we were back in July before the last correction. And on a relative basis, the Qs corrected from a ratio of 130 down to maybe 125. So it had a 5% relative correction. So a lot of times when you're looking for entry points, what I look at is a relative entry point, i.e. I want to still be in growth, so I want to beat the world index, but I want to enter a position when I'm at the lower end of the range in an uptrend. Okay, so you're not buying into strength, you're buying into weakness. Here's what's very interesting. You had the yellow line in the middle there spike into the March lows. So while the Qs were falling on an absolute basis, on a relative basis to the world index, they were outperforming. And this is the key difference between relative risk and absolute risk. And it's a very, very important concept when it comes to long short trades or when it comes to absolute risk. So ideally, your key buying points is when something's oversold on an absolute basis and on a relative basis, and it's something you want to own long term. So drilling down even further, where could this correction in the Nasdaq go? Coming off the overbought situation, and for that, I like to look at moving averages. I like to look at old highs. So the February high from where we ultimately broke out from. Now, interesting, going back to June, we saw a breakout 1, 2, 3, 4 days. We saw an island reversal. We saw a massive gap down back below the breakout, which technically is a terribly bearish pattern that lasted for 2 more days until it broke out again. So, technical patterns work 50, 60, 70% of the time, but sometimes 20 or 30% of the time too. So interpreting price behavior is difficult. And if you want to join a trend that's breaking out, you're much better than rather than buying the breakout. Because look, in late June, you got a breakout to a new high. You made a high by 1 day. You got a reversal of 3 or 4 days, and then it kind of pulls back. And you generally in an uptrend want to buy the pullbacks, not the breakouts. At least that's my style, folks. When I look for a breakout to an old high, support forms, you get the reversal, boom, that's usually a good time. Now, these are trading techniques. These are not investing techniques. And again, it's a very, very different experience between being a short-term in and out trader type and looking for that weekly chart, that long-term, that investable level where you can feel comfortable from a risk reward perspective that putting money to work, it might not be the bottom, but it's close enough that on a risk return basis, looking out a year or 2 years, you're going to have a reasonable outcome. I had said for months and months and months that and I was showing you charts weekly, bear markets unfold with multiple levels down. And frankly, folks, in 35 years of being in the markets, I've never been more shocked, surprised by the degree of support for the markets. But everything I've been talking about on Berman's call in my road shows for years about the massive debt and the Fed largesse and the fact that the only reason the market works is because money's free and the Fed's providing all this liquidity is not a bullish, it's not a reason to be bullish, right? But it could be a reason for the markets to go higher. And it's very hard, it's hard for me personally, and it's very hard in general to divorce yourself from that difference between the quality of a rally, i.e. the 1990s bull market, that was the beginning of the internet, the beginning of the bull run, the end of the war with the Russians, or the Cold War anyways. You had this peace dividend, and you had massively declining interest rates from very, very high yields over the past few decades. So you had these massive tailwinds. So now interest rates are at zero. They're printing money, but the markets are still responding to the liquidity. So again, very, very interesting times we have now. And frankly, folks, the most difficult I've seen in my entire career. So when we're at that point where risk and return, there's no price discovery. The Fed's underwritten the market. So for me, I like option strategies and defining your risk return as ways to play further upside from here relative to downside. And so I get asked a lot, and thanks to Renee for talking about some of the basics of covered call strategies, but people ask me kind of how do you go about doing this? How can I learn more about options? And frankly, I can teach for hours and hours, and maybe through our YouTube channel, we'll start doing some of these educational things on these webinars and replay them and have them out there in perpetuity on our YouTube channel. So But here's a way to say, okay, here we are today, and I did this basis a few days ago where the Qs were trading at 285.75. So what I said there was, okay, you've been in the Qs, you don't like the risk return, but you still want some upside because maybe it keeps going. So you sell your Qs and you replace the position with a call spread. So you're going to buy an at the money call to, Renee talked about at the money, currently the value of the market. So a 286 call out to the end of the year. So December 31st, 286 call. And if you look at the price there, you can see 1907 is the ask, right? So I got the graphic from the Bloomberg price chart there, and you can see the December 31st settlement date, and the bid is 1894 at the 286 strike, and the offer is 1907. So you can probably buy inside of that, but let's say you're paying the full 1907. Now at 1907, the implied vol to the end of the year suggests that break even is at 305. 286, 1907. So the market maker is telling you that I'll sell you that call, but I think by the end of the year, it could be about 305. Not for sure, not at all, but that's what the implied volatility of the option premium is pricing it at. So in order to make money, if you just bought the call, it has to be above 305. So in percentage terms, 19 points on 286, that's like 6.3% higher. So you're going to make money above above 305. Now let's say, and I use 304 to be just under that. So let's say you buy a call spread. So you think, okay, the market maker's right, and it's only going to go to 305 by the end of the year. So I'm going to sell the upside beyond that. So I could do the 305, but I picked 304 because on the screen I was on, I could get 286 and 304 on the same screen. That's the only reason. So I get the bid for the 304 call is 10.15. So I can buy this call spread now for a net of $8.92, which means I'm now profitable above 295. So I've got much more upside, assuming the market maker's right, and my upside is capped at where they're writing the option. Because if they thought it was higher, implied volatility would be higher and the option price would be more. So that's how, when you think about option pricing. Now, if I don't want to spend $8 to do that, and I want to buy a dip in the Qs, which I do, you can say, okay, what can I sell in terms of a put? So when you sell a put, you must buy it if it's below that price, okay? So now I can sell a 250 put to December 3rd and get a $9.03 premium. You can see that. If it was the 249, it would be 882, and if it was the 251, it'd be 924, and so forth. So you can structure an option strategy to say, okay, I'll buy a dip at 250 because I want to be involved. I want to buy a dip, but I also think there's upside. So I want some upside. This strategy net pays you 11 cents less your commission. So let's say it's free. Now I've locked in my profit. I've got the potential that if it's anywhere above 286, I make money because my call is going to be in the money. My 304 expires worthless and my 250 expires worthless. But the whole position cost me nothing. If it goes down 5%, I don't get put. I'm not long. I can buy it cheaper at that point. If it goes down more than 36 S&P or Q points, which is 13%-ish, then I'm going to be long. Okay, so you have a no cost, not no risk, because you're at risk if it's below 250, but you have to compare a strategy like this to a covered call strategy. So if you were long the Qs today and you thought it was capped at 304, you could write that $10 call and take in that premium, and again, make some extra money. If it goes through 304, you have to sell it, like Renee explained. But if it goes down, at least you've taken in $10 in premium, which mitigates some of the downside. If it goes down to 250, you've given up 36 long points and you've taken in 10 extra from the call that expires, but you're worse off. So you always have to have a market view as to what type of position you want to put on, okay? But I want to do this when we're at extreme points where risk and return are very uncertain. So you can do this with basically the top 30 stocks in Canada, the banks, and a handful of other ones that have deep options liquidity. Beyond the top 30 names, you can't do it. You can do it with the TSX 60 XIU ETF, lots of liquidity in the TSX XIU. And you can do this with most major market ETFs. Standard & Poor's SPY, the Qs, Russell 2000, you could use EEM for emerging markets, and about the top 250 or so traded stocks in the US, where you've got plenty of liquidity in the options market to put on these call spreads and so forth. So I love these strategies, defined return and risk strategies, when you get to extreme parts of the market and you still want to participate. So hopefully that gives you one idea of how to play the upside. But let's say, for example, that you are worried that the correction could be even deeper. So what I'm going to show you now, again, reference to that 285.75 is the put series and what the puts trade for below 250. So let's say, okay, but at 250, I'm not sure that that's enough. So what you can do here is say, okay, where look at the charts and look at your levels, and you say, well, what level do I want to buy it at if it got there? So I looked at the retracements and I looked at a bunch of things, and I decided that around 220, 221 would be that level that I would be comfortable being outright long. Okay, so how do we do this? So here's an option strategy called a 2-by-1 or 1-by-2 ratio put spread. Okay, and again, it's a free position, not from a risk perspective, but from a cost perspective, because what you're going to do here is you're going to buy a 249 put to protect that 250. You can buy a 251 too if you like. Buy a 249 put to protect the 250 position. And now you can sell two 221 puts, so that if it goes down below 249, your put is protecting the 250. So now you're hedged. But at 221, you're going to buy twice as much of the Qs. Now it's another 15% lower at that point almost, right? So to another 12. So overall, you're talking about now a 25-30% correction from where we are today, 25%. But at that level, you would buy twice as much as you would, certainly at this level, because it's cheaper. And fundamentally, you've decided it's investable and you like it. So I love option strategies when the markets get to these stupid, silly phases. And these are a couple of the ways that we put on positions in our portfolios for our clients. We don't do this in the BMO funds versions. These are we do in our private clients version. So let me talk a little bit about the moral hazard and the what's going on with the central bank and inflation and Powell's comments today and we saw the Dallas Fed president come out, an hour or two later, and he said, basically, we're not going to do this forever. The markets do have to get used to the Fed not backstopping everything, except for the times that the markets are volatile and they have to come back, stop everything. But the size of the balance sheets today, the big four central bank balance sheets as a percentage of their GDP, and just perspective from where things can go. So the GDP of the US today is about 20, well, it's down 10%. So it's 18 trillion and the Fed balance sheet is 7. So these statistics are actually based on before the collapse in the economy, where the Fed balance sheet was about a third. And the Bank of England's about a third, the European Central Bank 54%, the Bank of Japan at 124. So here's the thing about don't fight the Fed. What about don't fight the Bank of Japan or European Central Bank? Because they've had zero money, they have more central bank largesse, and their markets have sucked for years and years and years. And the Japanese market peaked in 1989 and is still 40% below those peaks. And the Bank of Japan's balance sheet is colossal as the size of its entire economy. Do you want to know why? Go back to the first chart that I showed. If Apple, Microsoft, Amazon, and Google traded in Japan, the Nikkei would be at all-time highs. That's it, folks. It's that handful of stocks that are working, where the average stock for 20 years now has sucked wind and not made anybody any money on average. We have this crazy, crazy world we live in. That's it's really, it's I'm beside myself. And so when I look about the quality of the rally of the economy, it's only working because money's free. But that's not the case in other places. And so the Fed, being the reserve currency of the world, has this luxury. Do not pass go, do not collect to it. They have the get out of jail free card, and it continues to work. But look at this chart here, personal consumption expenditures, and inflation, because the Fed now today told us about inflation, and they told us now that we want and we're willing to see it to go above 2%. You can see this is the Fed's favorite measure of inflation, this core PCE that's the factor in driving the GDP calculation when you talk about nominal GDP and real GDP. So, going back to the 70s and the high inflation and the strong union labors and everything else, that, the 70s were really bad. Now, the Fed is not going to let inflation run away. But if they sow the seeds of inflation over the next couple of years, and eventually we get past COVID and things recover, and if the Democrats win, they're going to spend bags and bags of money, and the debt's going to keep going up. And for now, the Fed's going to keep monetizing it, and equity markets may very well behave okay because of that central bank support. And I said fundamentally, and I said for months, and I look like an absolute fool now, but I said fundamentally, I think my buy list comes out below 2,000 on the S&P, and we didn't get there. So I lifted my hedges near the lows, and we bounced, and then I re-hedged, because every bear market that we've ever had with a meaningful recession, and this one's the most meaningful in 100 years, plays out in steps as we go down. And so this time is different. It's so unique, but the amount of support the Fed's put behind it and the spending of governments is colossal. But this is not bullish. I can't emphasize that enough. All the problems we had before are even more magnified now. But it's clear from the market perspective that the party can keep going, right? Because, the markets got stupid and overvalued, in 1998. The average stock started going down in mid-1998, but the NASDAQ doubled in 6 months in 1999. So we very well might see this kind of behavior. Now, under Donald Trump, there's much more possibility for upside than there is under Joe Biden. And I'll get into that a little bit. But here's the Fed balance sheet. And so as the Fed started to tighten, we saw in 2018, early 2019, the markets corrected hard. The markets cannot rally unless the Fed is printing money. So, when is the next big risk? Well, there's two. There's uncertainty around the election and policies related to spending and taxes that will have a direct impact on profit margins and multiples in markets. And then there's this Fed. And so when is the Fed going to stop being the Fed? Markets at all-time highs. So you got to ask the question when the Fed sits down next to meet, do we still need to do this? So at some point here, and I don't know, this is not tightening, right? This is not, we're not thinking about tightening. This is let's keep cutting the size of purchases until we're not buying anymore. So that won't probably be until there's a vaccine. So there's a very real risk that if Trump wins and we get a vaccine in the first half of next year, the markets can keep rallying into that. Very real chance that can happen. It's not my preferred scenario. It's not what I expect to happen. I expect Joe Biden to be president. Whether they get a full sweep in the Senate is going to be a very close call that I don't think we can predict. If you get a Republican Senate, even by one vote, you're going to get some gridlock. And so the Democrats aren't going to be able to spend as much as they want on green. They'll blame it on the Republicans and there'll be more squabbling, but ultimately there'll be less spending. So that could be a bit of a negative. They may not be able to get the tax hikes in that they want, but they'll get some. So those things are unknowns. But definitely the market should behave better under Trump, and we just don't know. But heading into that, we should see some of the froth come off. Now, I'm not talking about new lows. I'm talking about 5, 10, 15%. Again, what is it going to be? I have no idea. But some cooling from this overbought condition we're in today, based on seasonality weakness in September and October, and based on uncertainty around the election and tax policies and what they may be. Now, it could be offset by this Robin Hood gang of merry thieves who just don't care about valuations, and all they care about buying stock splits and index inclusions and things like that. So let me talk a little bit about that now. Apple announced a 4-for-1 stock split on July 30th. It's rallied 33%. There is no value added whatsoever in a stock split at all. Fundamentally, no value at all. Now, historically, it made the average stock more affordable for the average person or the average board lot. But that game ended a long time ago. You can buy fractional shares, you can buy one lots. That game has changed. But what's gone on here is completely speculative. But what it reminds me of, so that analyst at Wedbush that everybody loves on Apple, I can't think of his name off the top of my head, but he just did a Blodgett. And if you remember what Henry Blodgett did was, every quarter the Qualcomm would reach his price target or whatever the speculative tech stock was of the day that no longer exists. He would raise his target. So he recently, to get headlines, raised his target on Apple to $600. He was at 480 or something, and he just so you got the analysts playing the pom-poms, and you got a lot of but there's no value added in that stock split. So I think at a minimum, when this thing corrects, we go back to some of these points, from where it was, because right now the 1 year forward average target for the 40 odd analysts that cover Apple are lower than where it trades today. Right? Not much lower, but we're fully priced. Now there's index implications for when Apple splits, and very specifically, for the Dow in particular, because the Dow is a price-weighted index, and when the value of Apple gets cut 5 for 1, or 4 for 1 in this case, it's now trading at $125. And it's not a cheaper stock, right? You have 4 times as many outstanding now, so earnings per share don't go up. But it seems to me the less informed investor kind of believes that narrative is an issue. Here's the next one that makes absolutely no sense whatsoever. But the August 10th, they announced a 5 for 1 stock split. And they had been speculating for months now after the recent earnings that they were going to now be eligible to be included in the S&P 500. Tesla's in the queues in the NASDAQ, but it's not in the S&P 500. Now, Tesla today, I read an analyst report. So GM is trading at a value of $10,000 per car that they sell. Tesla is trading at a value of $1 million per car that they sell. Now you could argue that Tesla is about batteries and new technology and all kinds of things like that, but that doesn't line up. So here's the thing about index inclusions. So you have some convertible bonds that may be dilutive soon. And you also have the potential, because Elon Musk needs money, rather than issuing debt now, that he issues stock at these extreme valuations and sucks up all the money these people are buying Tesla for, because when it does get included in the index, there's going to be about $40 billion of index-based ETFs and mutual funds that are going to have to buy it. And that's the narrative behind why Tesla is running here, is because of this expectation. Now, the Standard & Poor's Index Committee, they're not dumb. They're seeing this, and increasingly they're not liking this front running on the indexes, and so they're looking at other ways of starting to include things in index. And maybe they do it in smaller increments, and maybe they only add a small piece, and so forth. So, but once that September 18th date for the rebalancing, now the announcement would be about a week before that. So within about 2 to 3 weeks, we're within a major inflection point. Now, if Musk decides that he wants to issue more stock because he needs more money, and all that money that's been speculating over that, we easily go back to 1,500, easily, but we could easily go back to 1,000. So the risk in Tesla is 25 to 50%. Now today, I don't know what the price is. It's just gone off it's gone bonkers actually. This was from a few days ago. So, but be careful with these names if you're in them. Really be careful. So the Dow Jones Company announced some changes this week to their indexes, and they're dropping ExxonMobil. So Chevron and Exxon were the big energy companies, and they're replacing them with some other names. Raytheon, which is much more of a military type industrial, replaced with Honeywell, which is a much more of a technology-driven industrial, and far less of the military side of things. But basically, it's new economy. So it's going from the energy which is going to be less and less and less in the future. And they're replacing it with the new CRM is Salesforce, if you don't know that ticker. And that stock on earnings is up 30–40% in the last few days. So you got all these stocks coming into the indexes that are now been front run from that inclusion, and these come in on Monday. And Amgen's, going to replace Pfizer. And so when you look at the changes to the index, you can see that with Apple split, which is going to be on Monday, the technology weight in the Dow is going to go down by 5%. The healthcare weight's going to go up by 4%, and so on. And you're going to get more of an emphasis on better quality companies for ESG. And you can see some of those behavioral changes in the index. So indexing is very, very interesting. And because ETFs are based on indexes, I thought I would talk a little bit about that. And again, I'm going to talk more about that on the show tomorrow. And that's the meaningful part of my blog. So I like Peter Bookvar. He writes the book report daily. People you like bonds and macro and fixed income. So he put out this chart the other day, and it's quite colossal. So it's the S&P 500 overlaid with consumer confidence. And generally the correlation with consumer confidence, because one of the factors they ask about in consumer confidence is do you think stocks are going to be higher or lower? We had a reading on US consumer confidence that actually made a lower low than what we saw in March this week. At the same time, the stock market's making a new high. So this has never happened in the history of 40 or 50 years that they've been doing consumer confidence numbers. So if you don't think this market is unique and different, this is an interesting thing. So who owns the stock market? Well, turns out that 87% of all US stocks are owned by the top 10% of income earners. So the inequality issues, and I think the inequality issues are front and center with a lot of these protests, and Black Lives Matter are very important. And so you're seeing this cultural war. It's playing out politically. And I think it's going to be a big factor in the election. So as we get into, who's going to win, again, Goldman Sachs did a study that if Biden wins and implements his policies next year, that's going to be worth approximately $20 in S&P earnings. So there'll be no earnings growth at all next year. And the markets, therefore, have never been more expensive on a PE basis or an enterprise to EBITDA basis. And so there's going to be a correction. How much, I don't know. Are we going to make new lows with the implied support by the Fed and all governments are willing to do to spend to get us through this COVID? Probably not at this point. But if you ask me where fundamental value is for the index, it's still below 2,000. So I've got to rationalize for me and for the people who own the funds that I manage. I got to balance this between how can we grow portfolios in this world that makes no sense whatsoever other than the central bank support and free money. So here are 4 of the sites that I look at that estimate in various different ways who's going to win the elections, and I would encourage you to follow them. I'll be talking about them in the lead up to the elections as we start our next series of weekly webinars that are replacing the Berman's Call Roadshow going into the election in November. So we're going to go every week from October 1st right through to December 3rd. back to weekly. Again, this is replacing what we traditionally do when we go out to the Cineplex theaters and like to see everybody in person and do sign. And that, listen, that we'll go back to that, assuming Cineplex is still in business in 2 or 3 years, when there's vaccines and when people are comfortable going to big venues and not worried about COVID. And so that'll come back, and we'll always want to get out there, but really for now the webinar versions are where we're at, and hopefully those are good for everybody in terms of getting their questions answered and so forth. So you know, when it comes to, it doesn't matter who's going to win the election trades, I still think that technology in a very, very big way is going to be the leader, notwithstanding the current massive overbought condition and the risk of corrections and pullbacks. And I've said for a while, you know, these are the names that I like and want to kind of include in portfolios when there's better value. And for months now, we've been waiting for these pullbacks, and they haven't come. They haven't presented themselves yet. And if I have anything, I have a lot of patience. And the volatility here and seeing the markets go up, and it doesn't bother me at all, because I know at some point we're going to get this correction. So I want to start getting into the Q&A here, and I want to start bringing up some of these charts. But I wanted to go through all of these and show you some of the, you know, what I would be looking for. And so from an investable standpoint, you want at least a return to the lower band of this long-term up channel, right? And we saw a break through the lower band, you know, in March. So at a minimum, the midpoint of the channel would be on a trend basis fair value. And so we're a standard deviation above that now. But relative to the benchmark, remember I showed you a couple of charts ago, we look at relative, it's starting to get interesting. So meaning the world index has gone higher in the last month, and this has kind of gone sideways or gone up at a lower pace. So we're getting close to a relative buy, but we're not there on an absolute basis. So if this is going to be 5% of your portfolio, on a relative basis, it could be, say, 2% right now, and you wait for the correction on an absolute basis to make it your maximum. Whatever that is for you, if it's 5 or 10% or whatever it is on an individual position. I'm not going to tell you, you know, what's right for you, because I don't know your risk tolerance and things like that. But you know, if you're looking at a portfolio of 20 different ETFs, where you know half of them might be core portfolio, S&P 500 and TSX, and the other half might be these niche individual kind of holdings that you might want to, you know, leg into it. Some of these have options, so you can buy a piece now, but you can write a put, you know, within the next 6 months to buy it at 30, and you can get paid the premium while you wait and so forth. So lots of great potential ways to buy these things. So ARKW, I love the ARK ETFs. So this is next generation internet, 5G and the like, and you can see this is there hasn't been any meaningful corrections at all to get in here. So and there may not be for a long time, or there might be when we get another major market correction, which may not come until next year. So this is going to be one that's going to be really tough for us to own, given how overbought it is. And when you look at some of the fundamentals, what the PEs are and such. But clearly from the investable standpoint, it's a theme that over the last year, that yellow ratio, 183, means it's outperformed the world index by 83%, right? Because going back a year, this is a relative performance over a year. It started at 100. So that's a little bit how I look at these things. And the RSI for me is a very good gauge. What I'm looking at here on the bottom is the RSI of the yellow line. So it's the relative strength of the relative performance. And so again, if you're looking for entry locations, you want to buy into pullbacks and these little oversold, in an uptrend, if you're looking to nibble on when to get into some of these things. So again, I'm sharing with you some of my favorite tools here. SNSR, Internet of Things. Again, here's another one where recently we're starting to see some underperformance relative to the world index, not correcting on an absolute basis, but sideways relative to the benchmark, going up. Robotics, artificial intelligence, so robo, have a look at that one. Again, another thematic trade that I like a lot. On a relative basis, has underperformed since the June peaks. It's still going up on an absolute basis, but relative to the market, it's been largely sideways. Clean energy, this is a big one that is, if Biden wins, is going to get some big money coming in. But you can see here where over the last year it's outperformed by 28% to the world index. So I love buying pullbacks and long-term stuff that's outperforming. Tech software, again, stay at home, cloud and all that. This is a much broader one that includes much more broader based exposure. Then you've got emerging market NASDAQ. So you've got emerging market tech, which includes, the Alibabas of the world and the Tencents and such. And again, as rhetoric against China has increased, the relative performance has eased on these. The absolute performance, still going higher. For those of you who are seeking dividends but want a play in technology, this is a technology-weighted dividend exposure. So you're getting about 2.5%. By way of comparison, the NASDAQ yields less than 1. Dividend-paying stocks have been underperforming for a long time. So again, the ratio is at 1 now, so same as it was a year ago. So it's market performance versus the global benchmark. But again, if you want to play technology, it's still up. But you want that dividend, this is one. And then genomics. And I think this is very interesting, again, where the world's going. I'm not talking about the moral part of gene recoding and all the things they're doing with biotech to improve lives and regrow organs and things like that. I'm not speaking to the moral side, but this is an area that's getting a lot of investment and something that I like from an investment standpoint, big picture. So let's go to some Q&A now for the people that have written in some questions, and then we'll go to the lines if we have any time left here. So I really appreciate the webinars. How do I determine when I should start reducing my overweight in gold? So gold, so I said, I think it's got several years to run here. A large part of the gold bull trade right now is the negative real yield that you get in fixed income. And as the Fed is seeking higher inflation and as output gaps close, we're going to see inflation uptick. And I believe with sluggish economic growth overall, you're going to have a lackluster economy keeping bond yields low with the implied promise that the Fed's going to keep buying bonds. And you're going to have inflation tick higher, which means real yields, so the yield you get adjusted for inflation is going to keep falling, is remarkably bullish for gold, as well as a flight to safety hedge and everything else. So I think gold still has a lot of bandwidth. Don't get shaken out by the day-to-day noise here, but it's going to start getting noisy at all-time highs, right? It's going to have more volatility to it. And so I still think we're there. Now, a couple of targets I have in mind. When gold stocks get back to their old highs relative to the 2011 high, that would be an area where you'd want to trim some gold exposure, gold stocks in particular at that point. When we get to the inflation adjusted equivalent of gold's all-time high back in the 1980s of 800 an ounce, inflation adjusted today It's about 2,700. And I think we're going to get there before this is all done in the next couple of years. Okay, Sean, hopefully that answered your question. If the yield curve begins to steepen, will this cause mortgage rates to rise? As a result, will this benefit bank stocks and hurt the real estate market? So that's a great question, Paul. And the mortgage market in the States and Canada is slightly different. Mortgage market in Canada is about 0 to 5 years. And that part of the lending market is where central banks want the most downside pressure to keep yields low to facilitate home buying and general spending from the consumer where credit lines are cheap and things like that. And that's different than the inflation part of the bond curve, which is more of the 5 to 30 year part. Now, banks fund their lending in the overnight markets, in what's called the swap market. So they're funding it at the 3-month interest rate, the LIBOR rate, where they can borrow money in the credit markets. So that's going to be anchored with policy rates to 0 for a long time. And you're not going to see a material rise at all in the up to 5-year part, because that's where they're going to, when they talk about yield curve control, Paul, is they're going to be anchoring rates to. They might let longer term bonds float higher and test to see what happens. And if they don't like the stock market response to that higher yield, steeper yield curve and higher funding rates longer term, then they'll start buying longer term bonds again, and the curve will come in. And so we'll see how that plays out. But if inflation expectations really take hold, and it's going to be several years for that to happen, Paul, that's when you've got to worry about the 5s, 30s curve really blowing out in a big way. So I'm not sure we're there over the next year or so. And so from the perspective of bank earnings and net interest margins, that's largely the 0 to 5-year part of the curve, I don't see a material steepening. Loving your YouTube channel. Well, thanks a lot. I think it's going to be a great thing to further communicate again beyond the 5 minutes I get every week on BNN on the educational side. We partnered with National Bank for an ETF 101 series for beginners, and it looks like Tom, you sat down with your grandchildren here, and I got to tell you, that brings a tear to my heart, because it's one of the reasons I do it is because I love to give back, but it's so important that young kids don't make bad mistakes and learn about investing, and so I've tried to give that to my kids and instill that to my kids about savings, but nevertheless, I got one that's making the millennial mistakes with credit cards, and she wants more than she can afford, and it's a challenge. But so thanks for that. I'm completely boggled how we can make all-time highs in COVID, and so what's the way for me to short the market at this point? So the simplest way is the single inverse ETFs. But Tom, if you understood what I was talking about with the option strategies, buying put spreads is very interesting. So you can buy a put spread, define your risk on the downside, and if you're going to get the pullback, you make the money if it goes down, and you don't risk a loss of say shorting. So if you buy the inverse ETF and it keeps going up and up and up, well, then you're at risk because you're short. So option strategies at a difficult time like this in the market are very interesting for people. Now you can't, there's a lot of things you can't do in registered accounts as well. So those are only available in margin accounts and things like that. So that's one way to do it, but the simplest way to go short is buying the single inverse, not the leverage ones. It's the single inverse ETFs that represent a market. Nick is asking, thanks for all you do, and again, you're very welcome, Nick. And I love doing these things. We're frothy. How can we recognize the top? Nick, I'm working on some indicators like the fear and greed index to come out, and I'm going to have at some point a weekly review on the Berman's Call channel on YouTube once we get this indicator built and on the website. But the idea again is market bottoms relatively easy because you see the capitulation, you see the spikes in volume. Market tops extremely difficult because of the inherent bias for markets to go up more than they go down. And so tops are very, very difficult. But when you recognize the froth, the idea is not necessarily to go short unless you have a mandate to go short, in which case that's fine. And if you lose being short in an up market, well, that's just part of the game because you've decided to go short and that's part of your goal. But if you don't have a mandate to go short, market neutral. So you're long the things you like all those tech names, but you short out the market risk with options, with hedging strategies. So those are some of the things you can do in portfolios, and again, some of the things we do for our private clients in our portfolios. I'm relatively new to self-directed investing. Appreciate your valuable insights. I've decided to invest in the Sleep at Night Dividend ETF for a conservative approach. I'm looking for a solid Canadian investment for a portion of my RSP funds. I'm considering Fortis and CN Rail. Would you recommend those for a long-term hold at this price? So let's have a look at the chart here. I'm going to throw that up over, and let's look at CNR first. So we've got Canadian National. So the thing about the railroads, they're much more sensitive to the economic cycle. But what was interesting here with CNR is it actually outperformed the world index quite dramatically when the market sold off. But since the recovery, it's underperformed. So it seems to have that characteristic of being a bit defensive. Overall, it's underperformed. It's up from a year ago. It's at the top of the band. So at this point, it's not a good entry location. On a relative basis, you would want to wait for this yellow line to, relative to the index to get a little bit lower. On an absolute basis, I would say you've got to wait at a minimum for a pullback to the old highs. Call that, 130-ish. And I wouldn't add here or buy it at this level. And the other one here is Fortis you're asking about. Right, so now you're talking about a utility, a dividend-paying utility, and again outperformed when markets went down. It went down too, but did much better. And it's largely a coupon clipping kind of holding where there's not a lot of growth prospects to it, given the current valuation and where interest rates are. And as you can see, it's really been a market performer or an underperformer over a long period of time, last 5 years anyways, versus the benchmark and so forth. So it's a good defensive holding right now. I'd be fine adding it from a defensive perspective, but their upside downside I would say is kind of balanced. What do we got here in time? We got about 5 minutes left. We've got a few more here. Let me kind of whip through these if I can, and let me see if I can answer at least one or two of the questions that have come in tonight. Paul asked, do the antitrust investigations into big tech potential Democrat sweep? So I talked a little bit about that. Yes, there is a risk there. I don't think it breaks any of them, but the two to me that have the biggest antitrust risks are Amazon and Google. Amazon's being investigated in lots of different ways, like what happened to Microsoft 20 years ago, where they kind of forced you to buy different products to use other ones and so forth. So that's what government doesn't like when they have a monopoly and it forces people to do things. And so, part of Amazon and part of Google in particular's value pack is you buy this advertising and you get this and so forth. So that's where I think more of the antitrust risk is than with, say, Apple, because Apple, in terms of market share on what Apple does, is still, it's too small of the pie for them to break Apple apart, from that perspective of selling product. Can I explain the mechanics of how the government might try to inflate the debt away? So you borrow a dollar today, inflation is 5%, and next year, and 5 years from, and 5% every year, and so they pay you a dollar back in 5 years, but that purchasing power has been eroded. So really, it's 75 cents you're getting back because of that inflation. So the higher the level of inflation, the more future dollars are cheaper for them to pay you back. So that's the idea of inflating the debt away. But if the size of the debt keeps growing at a faster rate than the economy, and if the amount of debt is the only reason the economy is growing, which is the case today, then you have a mathematical problem that's unsustainable, meaning the debt's going to keep growing and growing as the size of the economy, and you can never pay it off, which means interest rates can't actually go up because you won't be able to afford it. So today, the US government spends about $250 billion of the roughly $4 trillion they collect a year in tax, or sorry, not 4 trillion, 2 trillion in income taxes. And then when you add all the other tax, it's kind of like 3 trillion in that ballpark. Don't quote me on those numbers. Those are ballparks. And so, when debt is growing at a faster rate, so now they're borrowing, 5 billion this year. Well, 5 billion as a percentage of an $18 trillion economy today is it's a third. It's a colossal amount, and you're not going to generate any economic growth this year. You're actually going to have a decline. So you have a very, very complicated, unsustainable pace. Now, if interest rates go up, so the debt to GDP keeps growing, and your tax base is a percentage of your economy, right? Because that's the income people earn. So you're taxed based on the size of the economy. So if debt keeps increasing and interest rates are going up, that 250 billion becomes 500 billion, becomes $1 trillion. And now you're spending all this money just on interest that could have been spent on hospitals and healthcare and other useful things that now go up in smoke. And this is why the Fed needs to buy all the debt, because that interest payment then disappears. Because if the Fed owns the bond, the money goes to the Fed, which goes back to the Treasury, and the interest payment goes away. And that's what printing money is. That's what debt monetization is. Again, that's not a bullish thing, but that's what MMT is. That is the world we're heading to, where they think because we can fund the debt locally, we can print all the money we want. And the thing that kills it all is inflation going up to the point where they can't do that anymore, because then you lose confidence in the currency, and then the benefit that the US government has that no other government really in the world has of printing unlimited amount of money, disappears. That's 5 years, 10 years, 20 years, 30 years away, who knows? One day that's going to become a problem for everybody. Is now a good time to invest in a sleep at night dividend fund, or is it better to wait for a correction? I'm the most cautious I've been in that fund in the history of that 7 years that we're running it right now. And so I'm ready for a correction. It doesn't mean the fund won't go down a little bit if we correct. But so now is a fine time to invest. But if you're uber conservative, you can wait for a pullback. But short run, 5, 10, 15%, I don't think we're going to see more of that left. Okay, so let me get to a couple of the online questions. Oh, we got 1 minute left. All right, well, so Mark asked a question about an ETF that only has 20 or 30 million in it, and the bid-ask spreads are wide. should we avoid those? So if you're going to trade them actively and the bid-ask spreads are wide, I would say yes. You don't want to use those for trading, but don't worry too much about the low. Overall, it's not market cap. It's how many people own the fund. The market cap is really the underlying stocks. That's the liquidity factor. And so when a spread is wide, it could mean that it trades in Europe. Europe's closed. It'd be emerging markets. Emerging markets are closed. Spreads widen out. Market makers can't keep things tight. But the vast majority of ETFs should be within a penny or two. Mark. Anyways, folks, we're out of time for tonight. Thank you so much for tuning in. I'm really thrilled to do these. We'll see you all again. Remember, BNN show is going to be on Mondays again at the 11 a.m. time slot, starting September 14th. The next couple Fridays, we're still on. And if you can support one of our charities, or if you're interested in dealing with my firm, or fee-based financial planning and understanding your future, or if you're a portfolio manager out there and you're interested in becoming a partner to what we do for private clients, then go have a look at Q Wealth. So thank you, everybody. Make your donations. Thrilled to match them. It's about cancer for kids and dementia and Alzheimer's for the rest of us. Thanks so much. Have a great month, and we'll see you again October 1st.